Hi, this is Gleason. Welcome to Chapter 1 on Bookkeeping and Accounting. This chapter is an introduction to bookkeeping and accounting. It has 14 topics. Each topic has its own separate presentation or video. In this chapter, we'll cover a range of topics related to bookkeeping and accounting. We will study the definition and process of accounting. We will clearly distinguish between the terms bookkeeping and accounting, learn the objectives or purpose as well as the benefits or advantages of accounting. We will look at the various accounting principles or concepts, cover certain terms that are relevant in this chapter, learn about double entry bookkeeping, learn how to identify a financial transaction as well as identifying an account. We will learn the principles or rules of double entry bookkeeping, verify the accounting equation, identify if bookkeeping is a science or an art, look at the various branches of accounting, list the limitations of accounting, and have an assessment of the topics covered in this chapter at the end. These videos are available on my channel, Learn Bookkeeping and Accounting. Let's start with the first topic of this chapter, the definition of accounting and its process. Accounting is a process of identifying, measuring, recording, classifying, and summarizing the financial transactions in terms of money, as well as verifying, analyzing, interpreting, and reporting the results thereof. According to this definition, accounting is a simple process consisting of a sequence of logical steps. It's not a rocket science. We need to identify the financial transactions, then record them. Later on, we classify them. At the end of a certain period, we have to summarize them. We need to verify the sanctity of the summary. After that, we can analyze and interpret the results and report or communicate the results as well as its interpretation to the owners and other stakeholders, as well as comply with various regulatory requirements. It is indeed as simple as that. During the accounting process, there are various questions that will arise. What, why, where, how, when. As we go through the accounting process, each of these questions will get answered in detail. This process of accounting reveals the basic features, attributes, or characteristics of accounting. Let us now break this definition into its individual components and analyze each term separately. Let's start with the core part of the definition, financial transactions. As per the definition of accounting, there are various steps performed for financial transactions. We identify a financial transactions, we record a financial transaction, we then classify as well as summarize the financial transactions, and later on we verify, analyze, interpret, and report the results of financial transactions. The entire accounting process is all about financial transactions and its result. If you look at the definition of accounting, it implies that you only deal with financial transactions and ignore the non-financial ones. Therefore, it is essential that you learn to distinguish the financial transactions from the non-financial ones, as well as personal transactions from business-related transactions. Since the scope of accounting relates to the financial business transactions only, all other transactions are to be ignored. Since there are business-related non-financial transactions as well, whenever we refer to financial transactions or just transactions, we mean business-related financial transactions. Don't worry, it's very easy to segregate them. We'll learn about that later. The accounting process or the steps in accounting are embedded in the definition of accounting itself. The entire process from identification of financial transactions to reporting the results to the appropriate stakeholders is the accounting process itself. Let's start with the first step of the accounting process, identifying financial transactions. The question over here is, how do we identify the transactions to be recorded? There is an entire topic 7, dedicated to this aspect. However, I'll provide an overview over here. Transactions or dealings between persons can be broadly classified into two types: personal and business transactions. Each type can be further subdivided into financial and non financial transactions. In accounting, we are not concerned with personal transactions. Personal transactions are not to be recorded in the books of accounts. We only record business transactions. Now our scope is clear. Always remember that we record business related financial transactions only. The books of accounts are always maintained for the business and not for an individual. To summarize, in accounting, when we refer to financial transactions, we refer to financial transactions related to the business only and ignore all other transactions. We'll learn how to recognize financial transactions in topic 7. Moving on to step 2 of the accounting process, measuring the identified transactions. As per the definition of accounting, it is a process from identification of financial transactions right up to reporting the results of financial transactions in terms of money. Money plays a very important role in accounts. Everything is done in terms of money. Money is the only unit of measurement used in accounting. Everything else is just additional information. Qualities of a person, such as intelligence, honesty, etc., physical characteristics of a person or an object, its attributes or features, weight, height, age, number of items, etc., are all irrelevant in accounting. The only unit of measurement that matters and that should be recorded is the monetary value of the financial transaction. That's it. Now let's move on to step 3 of the accounting process, recording the identified and measured transactions. The questions over here are, where do we record the transactions? How do we record them? And when do we record them? Let's start with where do we record the financial transactions. There are only two books of accounts, journal and ledger. Each book is a full chapter in itself, and we'll look at them in detail when we get to these chapters. To give you an overview, journal is the first book of entry. A transaction must first be recorded in the journal. We'll look at ledger in the coming slide. The next question is, how do we record the transactions? According to the process of journalizing. There are certain steps to be followed while recording a journal entry, as well as a specific format or layout in which to record them. We'll look at the process in detail in the chapter on journal. The next question is, when do we record them? The transactions should be recorded as and when they occur. They should be recorded sequentially, one after another, in the journal. The next step, that is step 4 of the accounting process, is classifying the recorded transactions. The questions over here are similar to the questions in the previous step. Where do we classify the journal entries? How do we classify them? And when do we classify them? Let's start with where do we classify the journal entries. As the question itself indicates, we do not have to start from the beginning. Once we have completed the journal entry step, we need to move on to the next step of classifying the journal entry. The same journal entry is to be classified or grouped into its respective groups in the ledger. The ledger is the main book of accounts and the final book of accounts. The next question is, how do we classify the journal entries? As per the process of ledgerizing. Here again, there are certain steps to be followed while classifying or grouping a journal entry into the ledger, as well as a specific format or layout in which to record them. The only aspect to bear in mind now is that in the step of classification, similar entries are grouped together. For example, all electricity bill payments made throughout the year will be visible on a single page. Similarly, sales will be grouped together, purchases together, etc. We'll look at the process in detail in the chapter on ledger. The next question is, when do we classify journal entries? The classification can be done as soon as the journal entry is recorded, or before day end, or before weekend. It's usually done just after recording the journal entry since the transaction is fresh in the mind. Moving on to the next step, that is step 5 of the accounting process, summarizing. The questions over here are, where do we summarize the ledger entries? How do we summarize them? Why do we summarize them? And when do we summarize them? Let's take the first question. Where do we summarize the ledger entries? Summarizing is done after the process of ledgerizing. It is done outside the books in the form of documents, which are termed as statements. How do we summarize them? We close the ledger and prepare the statements. Once the ledger is closed, ledger entries cannot be recorded in it. On closing the ledger, the balances are extracted from the ledger and a trial balance statement is prepared. On the basis of the trial balance, the main financial statements, that is the profit and loss or income statement, and the balance sheet are prepared. Why do we summarize them? In order to get an overview of our progress. We would like to know if we are doing well and reaping profits, or if we are incurring losses in our business, and what is the financial position. When do we summarize them? Summarizing is usually done at the period end to get the period end results. The main accounting period is a financial year. However, companies usually come up with quarterly results, which means that they close the books every quarter to get the quarterly results and finalize the results for the entire financial year at the financial year end. The financial year end results are termed as the annual results. The next step, that is step 6 of the accounting process, is verifying. The questions over here are, what do we verify and why do we verify it? Let's start with what do we verify? The books of accounts and the financial statements. We validate the correctness and sanctity of the financial statements against the books of accounts. Why do we verify it? The books of accounts have been maintained by the accountant. It's usually a junior accountant that does it, or a bookkeeper. The senior accountant usually prepares the financial statements. The financial statements are supposed to reflect the true picture of the organization. How do we guarantee or certify that the books of accounts and financial statements are true? By verifying the transactions recorded against the documentary evidence of those transactions and ensuring that the financial transactions have been prepared correctly with the right information. The next question is, who verifies it? In case of a small business, it is usually verified by the accountant who files the tax return. In case of large businesses, they have the auditors. Large businesses may have their own internal audit team which verify the transactions and the financial statements during the quarterly period end. At the end of the financial year, large organizations usually employ external auditors to verify the transactions and certify the financial statements during the annual financial year end process. Moving on to the next step, that is step 7 of the accounting process, analyzing. The questions over here are: what do we analyze? Why do we analyze it? And how do we analyze it? Let's start with what do we analyze? We analyze the financial statements, that is the profit and loss or the income statement and the balance sheet. The next question is, why do we analyze it? Just as we summarize the books to get an overview of the profitability and financial position, during the process of analysis, we try to come with relationships and comparisons between various types of figures reported in the financial statements and present our findings to the management. Now let's look at how do we analyze the financial statements. There are certain comparisons that have been standardized and are in practice. These tools provide meaningful information about the financial statements. There is an entire chapter dedicated to these tools. These are ratios. We may have learned in mathematics about ratios and proportions. These are usually linked to mixtures of different persons or quantities or things. And we usually try to find the proportion of the different mixtures or the absolute values if we have been given the proportion. Similarly, over here, we have the absolute value in the financial statements and we derive the ratios. The next tool is comparative statements. This comparison enables us to compare our current performance with the previous period to check our progress. Another tool used is common size statements. This statement enables us to understand the revenue mix. It tells us which cost component is what percentage of the revenue in our total funds. Yet another tool is trend analysis. This tool is useful in knowing the direction in which the expenses and incomes are heading. That is, are they getting better or worse? Moving on to the next tool, fund flow and cash flow statements. Over here, we analyze the financial situation of the business and check if we have sufficient cash and funds to continue our business or do we need to raise additional funds. We'll cover all these tools in details in the dedicated chapter, which is titled Analysis and Interpretation of Financial Statements. Once we have analyzed the financial statements, we present the analysis to our management. The question over here is, what does the interpretation reveal? The management will interpret the result of findings of the tools used to analyze and figure out the reasons for significant changes. Each tool is interpreted differently and conveys a different aspect to the management. Let's take ratios. There are various ratios that provide meaningful correlation between the figures reported in the financial statements. This proportion of correlation can be either healthy or unhealthy. This right proportion is essential for ensuring effective managerial control over the business and for steering the business on the right track. If a ratio is unhealthy, the management may take decisions to get it back on track. The next tool is comparative statements. We compare our current performance with past performance to see if we have improved and are doing well. This will reveal any increase or decrease in expenses, incomes, and financial position. In common size statements, when we look at the revenue mix, we can find out the percentage of cost involved in earning the revenue and can target the high cost ones to improve our profit. Also, if there are multiple products, businesses, or divisions, we can compare these and find out significant variations between them. The next tool, trend analysis, can reveal a trend of a particular cost or revenue over time. This item can be represented graphically to show a progress or decline over time. We would want our revenue to increase and cost to reduce over time. However, certain costs may increase if the proportion of revenue is better than the proportion of increase in cost. It's good for the business. However, the inverse is not good and needs to be critically examined. Fund flows and cash flows are more focused towards liquidity management. We need funds to run our business. These statements reveal from where will we get the funds and how will we utilize them. They also inform us about the adequacy of funds. That is, will we have sufficient funds or will we need to borrow funds to run the business? As we have seen, all the tools provide information of a different aspect. Interpretation and examining of these aspects will guide the management in planning the future course of action for the business. We can accordingly view if we have achieved the planned targets or need to take actions to correct the course of the business and accordingly set up budgets and goals for the next accounting period. The final step in the accounting process is reporting. The questions over here are: what do we report? How do we report? To whom do we report? And why do we report? Let's start with what do we report? We have summarized the books of accounts and prepared the financial statements. Later on, we have verified, analyzed, and interpreted those financial statements. These financial statements, which have been prepared, need to be reported. In case of small businesses, they wouldn't engage the services of accountants who specialize in analyzing and interpreting the financial statements. In their case, they would only report the financial statements. It's up to the owners to analyze and interpret the results on their own. In case of large organizations, the management would be interested in knowing the reasons for significant changes and plan, budget, as well as set goals for the next period. So they would need the analysis and interpretation of the results as well. From a regulatory compliance perspective, it is only mandatory to report the financial statements and prove that the correct amount of taxes have been paid and all other regulatory payments such as VAT, custom duty, employee related payments, etc. have been made. The results of analysis and interpretations are only needed for the management to improve their future performance. If the management wants to showcase the progress, growth, and sound management practices of the organization, it may, at its own discretion, report certain additional information resulting from the interpretation of statements. This is usually done by companies to attract investment or additional funding and increase its share value. The type of organization can also play a role in deciding what should be reported. In case of a single owner trading, retailing, or manufacturing business of a smaller scale, the owner just wants to file the annual return and wouldn't want to spend that amount of money every quarter or even once a quarter to analyze and interpret the statements. He just wants to know his earnings, the amount of taxes that he has to pay, and take care of the other regulatory compliances. In case of partnership business, the financial statements should be provided to all the partners since they are the joint owners of the organization. Again, depending on the scale of operations and the turnover, they may or may not require analysis and interpretation of financial statements. In case of companies, the shareholders are the joint owners of the company. The annual report consisting of financial statements should be made available to the shareholders as well as its lenders. The company may, at its discretion, include certain additional information derived from the analysis and interpretation of financial statements. This brings us to the end of this topic. In this topic, we have learned the definition as well as the process of accounting. In the next topic, that is topic 2, we will look at the difference between bookkeeping and accounting. These two terms are often used in accounting. Therefore, we need to clearly understand the distinction between the two of them. If you have found this video interesting and would like to learn bookkeeping and accounting, please do subscribe to my channel and click the bell icon to get notified whenever a new topic or chapter gets uploaded. The entire list of chapters, topics and related video links are in the description section just below the video. Click on the Show More button to view the complete list. Please click on the like button below and leave your comments as well. You can also share the videos by clicking the share button with your colleagues and relatives so that they too can benefit from this series. Thank you and stay connected.